with information. Where do you turn to get straight talk about retirement, investments, and your money? Lock it in to the longest-running financial talk show in Arkansas, and let us help you build the bridge between information and application. Real financial change begins right here, and it starts with you.
It's showtime! Woo!
Hey, on today's show, it's all about entering the retirement red zone and the risks that it presents. If you are 10 years or less away from retirement, we've got the action steps you need to take before entering life after work.
This is the Get Ready for the Future show.
And it is another edition of the Get Ready for the Future show, live streaming on podcast, on radio, wherever you like to get your information. We are there, and my name is Scott Inman. Glad to have you along. John Shrewsbury is here as usual, and Troy Johnson in the third chair today. Good morning to both of you guys.
Good morning, sir.
We are ready to talk about the red zone today. I feel like we need a little NFL on CBS music or something to go along with that.
Well, I have been to a lot of college football this year. Obviously, the Razorbacks have been playing in Arkansas, and we've had 3 weeks here and then 1 week in Dallas, and we won't talk about Dallas. But anyway,
well, actually, we are.
I guess we are.
There were some red zone problems.
There were
in that
some
game.
red zone problems in that game, weren't we? Yeah. But I don't know that there's a greater show in America than college football.
Yeah.
I know NFL is very dominant, but NFL is also boring. They dink and dunk plays. They don't play old school football in the NFL anymore. Mm-hmm. And I just love college. It's so exciting. The energy that's there is very palpable when you go to a college football game. Doesn't matter whether it's your team or not. You can go to anybody's college football game, and the energy level is just off the charts.
Even like the band. You've got a band in college football. I think the unpredictable nature of college football, which is some of what we're going to talk about today, right? I mean, anybody can beat anybody. You don't see that, I don't think, in professional football as much, but it's a bit of a wild card when you go to a game and the energy, you're right, is unmatched. Fans look forward to it all week long. The tailgating that goes along with it, and I know they do that in the NFL too, but let me tell you, I've been to every SEC stadium. There is nothing like tailgating in college football. And we know it's football season, so that's really kind of the parallel today for us with the retirement red zone. I think about that. We use that terminology a lot. It's not exclusive to GenWealth, but we use it a lot when we're talking about our planning process. It's a great way to think of when you're getting close to retirement and how you need to play the game differently. And you watch TV, you watch football on TV these days, and my gosh, the graphics on there compared to 20 years ago, like you don't even really need an announcer. They've got everything right there for you. But there's this thing now that entering the red zone, right? You see the little line, the little pre-imposed line on the field, so when you're entering the red zone. And why is that such a big deal? Well, first of all, let's describe it for people who aren't football fans. The red zone is from the 20-yard line in to the end zone on both sides of the field. Okay, so if a team is driving the football and they are closing in on scoring, when they get inside the 20-yard line, that is considered the red zone. So why is it such a big deal?
Well, it's such a big deal in finance because when you are approaching retirement, there's a lot that can happen to go wrong. As you have built all these years, your retirement assets up to a point where you're at the threshold of being able to retire. And now comes along a market like we're having right now. It causes a lot of pain and concern about what's to come as far as retirement is concerned. And Troy, that is the area that we help people the most with.
Yeah. You think about when you're watching a football game, at least for me, your team receives a kick. Now they have to drive down the field. Well, when they catch that kick and then they're, on the drive, you're just kind of watching. You're not too nervous. Once you get in the red zone, you start to think, okay, we got a shot at scoring here, but if we make a mistake, it's magnified in this zone. Yep. So the red zone for retirement is 5 to 10 years out from when you retire. Mm-hmm. And like we just talked about, that's where you do not want to make a mistake.
Yeah.
Well, clearly the retirement red zone is in play, and there are several factors here that I think come into play. One is the fact that, back in the Great Recession, if you will, 2008, people talked about their 401k becoming a 201k. Well, that basically meant that their retirement got cut in half, and they had to delay their retirement until things recovered because they were very close in proximity to their retirement date, and they didn't have enough money to retire. And they didn't have the ability to generate the income that they needed in retirement. And again, it's not about the asset level, but it's about the income that can be generated from those assets. And so the retirement red zone is that area of your portfolio's life, that time period of 5 years, 6 years, 7 years out from retirement when things could go wrong. You are subject to different kind of risk there. So as an example, when you back up and think about a downturn in the market like we've had in this year, if you were 20, 25, 30 years old, that just meant that you were buying shares at a cheaper price in your portfolio and you were dollar cost averaging, and hopefully that was going to come back up and you were going to make more money, and it really was an opportunity for you. Mm-hmm. But when you are close to retirement, Scott, then it begins to flash red and you're going, oh my gosh, my $500,000 is now $300,000 or whatever the case may be, and it really does cause people a lot of consternation when it comes to retirement.
When you think about the football side of this and the analogy we can draw, one of the statistics that has really become a big stat for football teams to analyze is red zone efficiency. So how efficient are you at scoring touchdowns in the red zone, and how efficient are you at just scoring points in the red zone? And if you think about, even the parallel to retirement, I think about why is that? Because there's another stat. It's not really a stat. I guess it is. That's been more of a recent development in football. The term explosive plays. Mm-hmm. You didn't hear that 20 years ago. I don't know what
plays.
Yeah, it's chunk plays. It's basically 20 yards or more. Because the reality is the reason the red zone is important is because most people don't hit home runs. There are deep 70-yard bombs occasionally, but the most often way you score is to plod along, move the sticks, get to the 20-yard line. And you think about that. That's really appropriate for the way you should build your retirement as well. You should not be looking for the hot stocks. You should set it into a risk tolerance asset allocation that is going to get you to your destination. It's about the slow simmer. It's not about the quick heat of a microwave. And then when you get to that 20-yard line, as Troy has already defined, it's 5 to 10 years out from retirement. That's when the investment strategy needs to change. So when you talk about, John, the 401k down to the 201k in 2008, that assumption is you were all in equities. And I think that's the first place we should probably spend time talking about, because to your point, when you're younger and your account value goes down, you shouldn't really be focused as much on the account value. You should be focused on accumulating shares. When you reach the retirement red zone, it should be about income.
It absolutely has to be about income, because that's what's going to replace your paycheck when you retire. If you're thinking about retirement, your first thing ought to be, okay, how am I going to sustain my ability to live? And one of the things that you want to look at is, what is your ability to generate income from your portfolio? Troy, in our Ready to Retire process, that is job one for us, is looking at that foundational level of income. We call it the required income.
Right, and you want to make sure your required income, that's how much it is just to pay all your bills and have a comfortable level of living, is coming to you on some type of quote-unquote guaranteed basis. So Social Security, pension, we look at potentially annuity income if you have a gap on that required income level. Scott mentioned that there's been some research done on like red zone efficiency and that type of deal there. So I think this is pretty interesting that from Stadium Reviews is our source on this, but if a team gets to the red zone, just all teams, they've done a study here. So if they get into the red zone, they have a 50% chance of scoring. Mm-hmm. You don't want to be in your retirement red zone 5 to 10 years and feel like you have a 50% chance of having a successful retirement. So we need to talk about some things that people can do to make sure their chances are much higher than that. And
we know from watching, I'm sorry to bring it up, but it's such an analogy. But the game,
on you to rip the Band-Aid off.
The game last weekend, right, for Arkansas fans, and obviously we know we've got people listening that aren't Arkansas fans, but for us, the three of us at this table, you were at the game, right?
Yeah.
And you had an up-close view of K.J. Jefferson inside the 20-yard line, inside the 2-yard line, reaching out to try to cross the goal line, about to score, trying to improve that red zone efficiency. And at a moment in the game that could have changed the Razorbacks' lead from 7 to 14, and really late in the half, maybe possibly putting it away. Possibly put it away, and he fumbles, and the Aggies return it all the way to the other end zone, and now it's not a tie game because they missed the extra point. But then the momentum, it's the momentum part of that.
Oh, yeah.
You think about how that can really change the game in retirement as well.
Well, and stop and think about this. Look, in 2020 and 21, we had the wind at our back. It was like happy days are here again. There is no way things are going to run off the rails as far as retirement is concerned, because look at all the market returns that we've had. And man, things are just going wonderful. And then all of a sudden, the game changed, just like it did in Arlington in a split second with a fumble and just a fluke deal where the guy hands it off to his teammate and he takes off down the sideline, and it was palpable. It was very definitively, you could just feel the momentum swing, and just the energy left the Arkansas side and went over to the A&M side, and it was incredible how that happened. But that can happen in your retirement as well, especially if you're not prepared. Arkansas obviously wasn't prepared for them to run it back, 97 yards or whatever that was. And so you've got a situation where you've got to be prepared for whatever may come your way. And that's why we talk to people about coming in to sit down and go over your retirement income plan with a financial advisor way before you are ready to retire. Preparing is the thing that gets you through bad times like that when the unexpected happens.
Yeah, I think that's the point. The preparation, and it is the plan. And we always talk about the plan, but the plan is built, Troy, and created when you're in the retirement red zone, and we put you through the ready to retire process, and you have a written plan with GenWealth. The plan expects what we've seen happen this year in 2022.
Yeah, and I think we need to talk a little bit about just timing risk on all of this, because if you were going to have a mistake, the A&M game, if you were going to have a mistake in the red zone, you would want it to be in the first half, right? I mean, at least then you've got the worst time to have a mistake in the red zone. It's a close game in the fourth quarter, and that's really what we're talking about here.
Yep.
It's the fourth quarter of your working career when you're that 5 to 10 years out, and that's when we really don't want to have a mistake in the retirement red zone. So maybe we can talk a little bit about that and how timing risk plays into all this.
So I mentioned in the first of the show that there are risks that you face in the retirement red zone and into retirement that you don't face when you're in pre-retirement years and farther out. And that first one is, as Troy mentioned, timing risk. It's also called sequence risk, but it basically, John, is the reverse of what you were talking about with dollar cost averaging, right?
Yeah.
When you're accumulating shares as a younger accumulating client or accumulating investor, you're not as concerned, or shouldn't be as concerned about your account value, because you're trying to accumulate shares. You are purchasing shares, so when the market goes down, you are getting more shares for less contribution, less money, right? And then when those shares over time hopefully go up, you've got more shares and possibly a better return. But the opposite is true because again, there's no question about it. The solution in retirement planning is income. The outcome is income. So you are going to be receiving some of your assets are going to be turned into an income stream on some level if you're going to use it at all. And then you are selling, right? So now we get back to, you need to be able to control when you sell and what you sell to be able to avoid what is known as reverse dollar cost averaging.
Scott, I was saying to a client just yesterday, the thing that destroys a portfolio is not necessarily a bear market, but the thing that destroys a portfolio is selling assets in a bear market, because you're not losing in reality. You're having a temporary decline in value, but you're not losing. You don't depossess those shares, if you will. You still have those shares. They're just of lesser value. But when you sell shares, then those shares are gone and never going to come back. And so that's one of the things that is a nuance, but it is a very critical nuance that we try to deal with here at GenWealth as we build our ready to retire process.
Yeah, and the way you do that is you keep a good cash buffer when you're in retirement. So if you've at any given point, if you've got 1 year to 2 years worth of what you're taking as income. So whatever you're taking out of your investments as income, multiply that by somewhere between 12 and 24 months. If you've got that amount in cash, then when we have a year like we're in right now, you're not in a position where you have to sell your investments that are down. You can just use some of that cash that you've got kind of on the sideline that's primed and ready to go.
Yeah, we use the story of two investors that we call James and Joe, and we've been using this for a while. I don't know how they acquired the name James and Joe. We could use any names we wanted, and we had a picture of these guys. And I always found it interesting when I'd show a client this, and both guys were smiling, but one of them shouldn't be.
Yeah,
right.
You're right.
They were both golfing, but one of them shouldn't have been smiling. So the scenario is this: James and Joe both work for the same company, okay, and coincidentally they arrived at their respective retirement dates with exactly the same amount of money in their 401k plan or their IRA or wherever you want to say that they were able to accumulate their wealth. And both men had $500,000 when they retired, okay? They both withdrew 5% of their balance, which we would certainly say is pretty darn high and probably shouldn't have been done, but that's what they did. 5% of their balance at retirement from each of their accounts to create income for each of their families to live on, right? So the only difference between James and Joe, they were invested the same way, they withdrew the same amount, they started with the same amount in their accounts. The only difference was the year they retired, okay?
Yep.
So James retired in 1966 and Joe retired in 1976. So you apply some actual returns beginning in 1966 and comparing that to 1976. What happened? And by the way, they were invested in a common 60-40 portfolio, right?
Right.
As represented by the S&P 500 and 10-year treasuries. Okay, so that's a typical portfolio from what a lot of advisors would say a retiree needs to be in, a 60-40 portfolio. We know how that's worked out in 2022, right? So if you just say the only difference was the year they retired, apply the returns that those two indexes got for the next few years, what do you think happened? What do you think? Well, James started with $500,000. 18 years later, in 1982, James was completely out of money. All right? They did actually raise their income for inflation as well, so they got a little bit more because they needed to, right? That's another risk we'll talk about. Joe started with that same amount of $500,000 in 1976, and because he got different returns, because it was a different time in the market cycle, he actually had $1.2 million 18 years later. Now think about that.
Now, how did that happen?
Yeah.
Well, it happened because of the order in which the rate of returns happened to each of them. One of them retired into a recession. The other retired into a bull market. And you don't have any idea of knowing. You don't have any way of knowing. You're not a prognosticator. You don't have a crystal ball to look ahead and go, oh, this would be a great time to retire. Because frankly, if you were in 2021, you thought it was a great time to retire. And now we're at 2022 and markets are down 15, 20%, whatever they are. And now you're going, oh my gosh, what happened here? And so there is no way to know. You have to actually strategize around that, Troy.
Yeah, you need to have a plan that whether the markets are good early in your retirement or they are poor early in your retirement, you have a strategy that meets your income needs. That's what we keep going back to here. You have to be able to meet those income needs. And, of course, we've kind of gone through an illustration here. So I think Scott, with his perfect radio voice, has a nice disclosure to read for us. Do it that real fast disclosure.
How did you know that's what I was about to do? Because just because I had the paper up ready to read it.
Disclosures are your favorite.
No, that's not true. But I will read it because we're supposed to. This is a hypothetical example and not representative of any specific situation. The results will vary. The hypothetical rates of return used do not reflect the deduction of fees and charges inherited to investing, and these are unmanaged and cannot be invested into directly. Past performance is no guarantee of future results.
God, we will.
You're the
we
FedEx guy.
We will rent him out.
Yes.
Perfect.
Oh, I didn't know if I was going to make it through that quickly, but I tried. So yeah, and it's true. I mean, obviously that is an example. Your results would be different, but there is data out there. John, I remember you and I going to a conference a few years ago in Boston where they brought out some information that the sequence. This example we gave was different years,
right?
But you could take the same calendar year, and do different months and still wind up in drastically different results.
You really can, depending upon what's happening in the markets and the economy and what have you. And our deal is, look, we're not going to try to time the market. We're not going to try to pick stocks around this. We're going to strategize around it. We're going to be sure that it doesn't matter what happens as far as the market is concerned, as far as your guaranteed income goes. Now, obviously, as you think about how this is constructed, and in your mind's eye, if you'll just kind of think through building a house where you have a foundation, you have a living area, and you have a roof or an attic. That foundation is what we're talking about right now, because what you try to do there is to create a balance sheet. You've got monthly liabilities, food, clothing, transportation, shelter, taxes, insurance, all the things that are necessary for you to live your life. Financially, those are all liabilities. And what you want to do is to match those liabilities with financial assets, not necessarily lump sum dollars, but in terms of monthly income. How do you meet those liabilities with the assets? Well, in the prior to retiring, you were in a situation where you had a paycheck that was created an asset that was available to take care of those liabilities on this side. You've got to replace that paycheck, and that's what the Ready to Retire process does first, is we look to replace the paycheck of the breadwinners of the family, so to speak, in terms of what their assets need to be taken care of in terms of income.
Look, there are three types of retirees. You have either overfunded your retirement, underfunded your retirement, or you're constrained. You're right there in the middle, at risk if you don't do it right, of running out of money in retirement. If you've overfunded it, well, how do you know if you've overfunded it first? That's the first question I would have. If you haven't done a plan for retirement income, how do you know if you've overfunded retirement? Certain people know, obviously, if you've got millions and millions of dollars and you're not going to spend a lot in retirement. But until you've gone through the process, maybe you have a 1.5, maybe you have 2, maybe you have 1, and you don't know if you've overfunded retirement. That needs to be the first thing, is a written plan with your income wants and your income needs considered and built into an income plan over the course of your lifetime with inflation-adjusted raises to see, do you have enough assets to support your retirement? And then you'd know if you're overfunded and have leftover funds available. Underfunded just means you probably haven't saved much. They have very little in terms of retirement savings, so you're going to have to rely on Social Security. That's what we call the fixed income retiree. But constrained investors, which makes up the majority of retirees, and the majority, quite frankly, of the people that we work with, they have saved consistency for retirement. They have done what they needed to do between the 20s, right?
Yep.
And here we are reaching the 20-yard line, getting into that retirement red zone. Is their savings is high enough, but they have to have a withdrawal strategy. They have to have an income plan that is sound and an investment strategy that takes into consideration the sequence risk that we just talked about, because timing risk is the greatest among the constrained investor.
Scott, those folks have a very thin margin of error. They don't have a lot of wiggle room as far as things going wrong in their plan or what have you. Let's go back to the football analogy. If Arkansas had been up, let's say, by 3 or 4 touchdowns, and we fumbled the ball in the red zone and they ran it back, okay, well, they got one on us, but we still had a big enough lead that we could have, survived that. But I think that when you are thinking about a very thin margin, and then you have that big swing in momentum and that big turn where you didn't put points on the board and then gave them 7 points, then you don't have time to recover from that. And I think that's really a very apropos part of this, Troy, as you look at trying to approach retirement in the red zone.
Well, like you just mentioned, that if we would have had 2 or 3 touchdown lead, that's your overfunded person in retirement. It doesn't matter that they gave up some gains or whatever, had a few losses in their portfolio. They were okay there. And then on the other hand, the other side of that, an underfunded person for retirement is the team that's already down by 3 or 4 touchdowns and they make a mistake. They weren't going to win that game anyway. But it's the close game. It is the A&M game. That's what we're talking about here. That's the constrained investor, and that's where having a plan is so important for that person.
And guys, we work with all kinds of retirees. We work with underfunded retirees. We work with overfunded retirees. But the biggest group of people that we work with are those constrained investors, those folks that don't have a whole lot of margin. They don't have a whole lot of wiggle room. They don't have a whole lot of ability to weather a big storm unless they do some things to solidify and guarantee some things in their portfolio. So clearly, the red zone strategy is to take care of business first. Be sure that your required income is locked down and taken care of in retirement.
Offensive coordinators will tell you that it's tougher to call plays in the red zone because of the shortened field. And if you think about what that produces, and the tendency to do is to get conservative, right, is to run the ball up the middle and hope you get to the end zone, right? And you think about without a plan, when a retiree or a pre-retiree enters the retirement red zone, without a plan, they've got this pile of assets, right, that they've saved their whole life for, but they're scared to use it, right, because they don't have a plan for how it's going to be used. And I think that's probably more common in a client meeting room when we start bringing people into the planning process than the other, as far as like, I'm just going to go spend frivolously and see what happens. But there's this just-in-case plan. The just-in-case retirement's what we call it.
Well, and building that foundation gives you the freedom to spend the other money. The rest of your assets, once you've built that foundation to replace the basic income that you need, then that gives you a tremendous amount of freedom to do what you want to do. Because, Troy, at that particular point in time, you know the bills are paid. And it's like having a bonus on top of your paycheck.
Yeah, Scott mentioned getting too conservative in the red zone.
Yeah.
And I see this all the time. People think, okay, I'm 5 years out from retirement. And you've heard that as you get closer to retirement, you need to take all of your money out of equities and you need to move it over to something that's more conservative. We think about it a little differently, because if you were going to use all of that money in the first 5 or 10 years of retirement, then that would make sense, because you don't want it fluctuating up and down very much. That's not how retirement actually works, though. You're still going to have a portion of your money, even if you're close to retirement, that you're not going to use until, 15 years and beyond. So that's one thing that we try to educate people on is, yes, we definitely need to take some portion of the assets and move them over to where they're conservative, and where if there is choppy markets like we're in right now, that's not really affected. But there also still needs to be a portion of your assets that is still set up and can take advantage of when the market goes up, because that's going to help us keep up with inflation over time.
Yeah, and I was about to say, Scott, that's the other risk that you really didn't have to deal with as far as your retirement is concerned as you were accumulating money, because inflation wasn't a factor. You weren't spending the money.
Yeah.
But now, when you think about creating income, you better have a way to increase that income over the course of your retirement.
Tim and I, who works with me here in the Little Rock office, we went to lunch at Chipotle yesterday.
Yeah.
And I brought cash. I don't always pay cash for my lunch, but I do oftentimes. And I was at the end of the line, and I pulled out my cash that I had with me, and I pulled out 3 5s, $15, because I know things are going up. And I got ready to pay my Chipotle lunch, and guess what it was?
$16.
$17. And I thought I had anticipated inflation. I thought I had planned for inflation.
Oh,
and
yeah.
man,
you don't get out very easily these days.
It's getting close to $20, and we know that. You
For
know
lunch.
that. Yes, you know that. I mean, people listening to us, watching us, they know that. We are in a exceptionally high inflationary environment right now, where we're in the 7 to 8% range. That's not going to stay the course through your retirement. You need to look at an average, and historical average is between 3 and 4, depending on when you look at the 50-year look back. But let's say 3%, even with a 3% inflation rate. In 20 years, you're still going to see that buying power eroded. So if you want $2,000 a month from your assets in day one of retirement, it's going to need to be twice that if you live a long retirement.
Yeah, I think about the fact that I remember, everybody remember the dollar menu? Is there even such a thing as a dollar menu anymore? Probably not.
You could probably get 2 nuggets maybe for that.
But, is it a $5 menu now? I don't know. But the point is that things are going to get more expensive the older you get in retirement. And you say, well, I might not be spending as much money. Well, that may be true, but the things that you are spending money on are going to be more expensive. And so I think it's just part and parcel. You've got to think about the fact that, first of all, if you go for 10 years in retirement, something that cost you $1,000 today probably is going to cost you somewhere in the neighborhood of $1,500 to $1,600 10 years down the road because of inflation. And then when you stop and also think about the fact that we are, as a country, generally, ex-COVID, and this, impaired the numbers a little bit, but we are generally living longer.
Yeah.
And so longevity is the third thing that we've got to think about when you're building that retirement income plan.
Yeah, and that's the thing that doesn't really sound to most people like a risk because, well, I want to live a long time, but it is a risk to your portfolio. It is a risk to your income, and that's why you have to plan for a long retirement. Troy, we say this all the time on the radio. I say it in the client meeting room. It is better because a lot of people will say, well, I'm not going to live to 90 years old, right? I don't need a plan for 90. Let's front load this thing. Let's spend it because I'm going to be dead at 75. And that may be true, but you have to be able to plan for a long retirement and it not happen rather than not plan for a long retirement and it happen.
Yeah, we don't want to see anybody completely run out of money. So on all the plans we put together, we're going to factor in, building in a backstop, which is basically just taking a small portion of your assets when you begin retirement, putting them in a growth bucket to where we're going to say, okay, this little bit of money, we're going to build you a 25, 30-year plan, and the goal for this bucket is just for it to grow for that time period. We're going to leave it alone, let it do what it does, and when you get to the end of that plan, if you're still here, that means now we still have money. We can kind of go back and split that up and continue income for you for several more years.
Scott, I think as painful as today's market is, and obviously we're going through a changing time now, but as painful as this is right now, I think this too shall pass. Just like in 2021, I was saying this too shall pass. Things will not ever be as good or as bad as you think they are. And so for folks who are listening to us today and going, oh, well, they're crazy as all get out because they're talking about investing in equities and equities are just plummeting. We've seen that before. But what we know to be true is that equities and real estate are the only two asset classes historically that have continued to keep pace with inflation and put you ahead of inflation, and that's what we're talking about overcoming. It is the risk of inflation and also the risk of longevity that your money needs to last a long time, so there has to be a growth component to that.
I saw the other day that the 2022 so far, which we're about to finish the third quarter, has been the worst year for the 60-40, the second worst year ever for the 60-40 portfolio. Now you think about that, right?
Yeah.
But you do still need some of your assets in equities in retirement, some of your assets in bonds. But those are not the only two asset classes. John, you mentioned real estate.
Right.
Cash, right, for the early in bucket. There are more than two asset classes. So this time in history not only emphasizes the need for a retirement income plan, it also emphasizes the need for diversification.
And we're constantly looking at those asset classes and trying to monitor whether there is an appropriate opportunity to introduce a new asset class to the equation. Some people would say, well, what about Bitcoin? Well, we don't think Bitcoin is actually an asset class. It's not something that we offer here at Gen Wealth. And so, but we are always on the lookout to say, times change, and we've got to think about how that change is going to affect someone's retirement income plan. And that retirement income plan is the critical factor here. And I think that if you look at creating a plan, that plan has got to be able to be molded and shaped based on what may change in your life, what may change in the economy, and what may change as far as your retirement is concerned.
So when you think about when you want to retire, if the plan's in place, you'll have some certainty on the table in front of you as to when you can actually do that. You hear the final bell there, and that means it is time for our final thoughts. And Troy, we'll start with you.
Yeah, so, retirement is your responsibility. You've got to make that happen. You have to be disciplined to save for retirement, and when you're in retirement, you have to be disciplined in how much money you take out and making sure that lasts for the rest of your life. But you don't have to do all of that by yourself. So really, no matter what stage you're in, we're here to help. Every athlete, even weird sports like golf, where it just looks like it's just a one-man show, they've still got coaches and people that help them along the way. Right,
you got a caddy.
Right,
yeah.
So, yeah.
Guys, I think that if you stop and think about the whole structure of retirement and this whole thing that we've used in the analogy of the retirement red zone, you can't be afraid to call an audible. And an audible is simply just making a pivot, making a change. If you've been rocking along and your advisor hasn't been talking to you about how you're going to sustain income in retirement and they don't have a written plan for you to do just that, then you probably ought to call an audible and say, okay, what else can I do? Who else can I consult with to get me from point A to point B in retirement? It is not the same as saving money during your accumulation years. It literally is a different game that you're playing. So be sure you get the right advice from advisors that are skilled in the area of retirement income, and we'd be glad to help you with that.
My final thought is take the first step. You can find out for free how likely you are to score in the Retirement Red Zone by visiting 15minuteretirement.com or text the word checkup to 501-381-5228. Again, that's 501-381-5228. And that's all the time we have for this week's show. We thank you for being with us on the Get Ready for the Future show as we entered the Retirement Red Zone. We hope there was some great information, some education for you. Don't be afraid to reach out and call for help, and that can be a written financial plan. We will talk to you again next week.
The Gen Wealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Gen Wealth Financial Advisors is an Arkansas-registered investment advisor with securities offered through LPL Financial, member FINRA SIPC.